The Fed just released its new monetary policy. Is it good? Is it bad? Is it going to continue tanking your portfolio? What can you do about it? Is the market going to continue to crash further? And what needs to happen for the bleeding to stop? We will get into all of this. I'm going to break it down for you all today so that you're not left out in the cold, because that is the purpose of this channel. For long-term investors, there's also a very bright silver lining here. So let's get into all of this. The Fed finally raised rates by 0.5 percentage point. This was not unexpected. If you look at the Fed Watch tool, there was basically a 99% chance that the Fed would do exactly what it did, which is raising rates by 50 basis points. I don't think anybody thought that they would go more aggressive than this. And even in the Fed presentation itself, Jerome Powell said it is unlikely that they will look at a 75 basis point rate hike for the near future. Now, you're going to hear criticisms all across the board. Did the Fed get it right? Did they not go far enough? Why is the market tanking all of a sudden? In my view, the Fed's hands are tied here. If Jerome Powell went too aggressive, we would likely see even more of a rout in the stock market, meaning the stock market would crash even harder, especially if he came out with unexpected rate hikes, further than what was already telegraphed multiple times before the FOMC meeting. And if the markets and the economy crash too fast after that, then the Fed is going to have to cut rates once again in order to rein it back. So their hands are really tied here. What could they really do as a reaction to taming this outrageous inflation that we have? Well, obviously, hindsight is 2020, but most analysts, most respected analysts and economists think that the Fed should have acted differently beforehand, but now their hands are tied. So what can they really do? Now, one hawkish measure that they did introduce is that they said they would start reducing the size of their balance sheet by June 1st. And don't worry, for the beginners, I'm going to get into briefly what this means so that you can keep up and you understand what's going on. So they said that they would start decreasing their balance sheet, reducing it on June 1st. This, as you can see here, this is a copy of their official statement, their official document. And this is from March, and the red are the changes that were made from March until May, right? So they added this verbiage here on reducing the balance sheet by June 1st, which was not initially in the plan, because Jerome Powell had said that they would start looking to reduce the balance sheet by the end of the year and not as early as June 1st. So because all eyes are on interest rates, and interest rates are the instrument that are directly tied to some of the consumer-related loans and rates that we have. Think car loans, mortgages, personal loans, savings accounts, etc. Because rates are directly tied to those things, there are more eyeballs on the rates. Like if Jerome Powell was going to be more hawkish on the rates, regardless of what happens with the balance sheet, then the media and investors are going to pay attention to that more hawkishly, right? However, if they raise rates by the expected amount, but then they start making modifications, hawkish modifications on the balance sheet, then it is seen as more of an indirect move to try to tame inflation. However, as we've been stating on this channel all this time, that if earnings are not good on the mega caps, earnings season already started, most of the mega caps have reported. If earnings season is not good, there is nothing to save the market here in the short term. We've had muted guidance from Alphabet, muted guidance from Facebook, terrible earnings on Amazon, decent and expected earnings on Microsoft, decent and expected earnings on Apple, and a positive blowout of earnings for Tesla. So really, out of all of the major companies in the S&P 500, there's only been one that exceeded expectations. Most of the others have muted expectations or negative expectations. And then the other two are as expected, right? So nothing to write home about. And if the only thing that you know how to do is buy stocks, then you are left sitting on your hands watching your portfolio bleed. Now, again, as I said, there is a silver lining, which we will get into at the end of the video. But I know how frustrating it is to wake up every day, and if the only thing you know how to do is buy stocks, you're looking at this like, what am I left to do? Just remember that you are buying stocks for the long term. You are not buying stocks for the short term. If you want to learn how to swing trade or day trade, that is an entirely different discipline. That is not something that you're not going to buy the NASDAQ here and then, expect it to go up randomly in a downturn when we have all of these negative factors. This is why remaining neutral every single day is one of the most valuable tools that you can add to your arsenal. This is something that we do every single day. We wake up neutral. Nobody can tell you what the market's going to do on a day-to-day basis. The market, as at the time of this recording, the NASDAQ was up almost 4% yesterday. It's down in one of the worst days today, over 5% down. Who could picture that? Nobody. However, based on the levels that we draw pre-market, we add puts to our position if we fall below these levels. and add calls to the position if we rise above these levels. Ended up closing our QQQ puts way too early today for 264%. These eventually went up to 500%. As I said, the NASDAQ had one of the worst days in its history. Now, this is real ironic because yesterday we loaded up on calls as opposed to puts. The point is, if you want to learn how to swing trade or day trade, you have to equip yourself with these tools. There is nothing wrong with buying and holding long term, but it's not going to be fun if you check the market on a day-to-day basis. So you might as well participate if you're going to be doing that. And if you want access to all of our day trades, all of our watch lists, you want to learn how to day trade, we have a beginner section where you can ask our coaches anything you like. We have a beginner education section that we keep updating with free resources. You can get almost 30% off your monthly membership if you use the coupon that is in the description now, which is going to go fast depending on when you watch this. So if you want, come join the group, be a part of it. All right, so what does the Fed balance sheet reduction mean? Well, the Fed ends up buying treasuries and mortgage-backed securities during times when the economy needs a boost, right? During times of a recession, like what we had in 2020. Who's the Fed buying this from? The Fed is buying this from the banks, right? So the banks give the Fed these treasuries and mortgage-backed securities. Let's just draw little papers for that. And the Fed gives the banks money. They are injecting money into the economy. And this is cheap money. Now, because interest rates were very low, effectively 0%, the banks can now loan this money out to businesses, to people at very cheap amounts, right? That is how money makes it into the economy. Now, what happens when the Fed is trying to tighten policy and take money out of the economy because inflation has run too hot? Obviously, with all this money that is in the economy now, all prices go up because there's way more money and way more spending power in the economy. Not to mention supply chain constraints, which is a whole other piece of the puzzle, but the Fed cannot fix the supply side. So now what happens is the Fed has to reverse course, right? Here's the Fed, here are the banks. Hopefully this makes sense to a lot of the beginners here. And now the banks are giving back this money because the Fed is going to be selling them these treasury securities at a discount, right? So the Fed gives up these securities to the banks give them money for it, and interest rates are now higher. Let's just say that the Fed funds rate right now is 0.75%. Remember, it was 0% before March. Now it's 0.75%. So not only is there less money in the economy because the Fed is now taking money out of the system, but banks aren't lending to businesses and to individuals at 0%. So people now have a decision to make. They're like, this is actually now getting more expensive. Should I buy that house? Should I buy that car? Should I start that business? Well, now the cost of borrowing money is up, so there will likely be less people that are willing to borrow. This is how you remove money out of the economy. When you remove money out of the economy and demand slows down, right? Because the Fed can only affect the demand side of the supply-demand dynamic. That means that prices will now start to go down. So this is what all of this means. This is how the macroeconomic picture works. Hopefully this makes sense. If you have any questions, leave it in the comment section below. All right, so will the stock market continue to crash? Well, as I said before, if earnings are not great, the stock market will likely continue to crash. If earnings are great, and we have now two more pieces to add to your watch list, right? Two more pieces to add. CPI numbers, which come out May 12th, I believe. Sorry, Wednesday is May 11th. So CPI numbers come out May 11th. And we have now this extremely scary prospect of a recession. So as you see here, we've had our first negative GDP percent change from quarter to quarter. Remember, a recession is defined as 2 negative GDP quarters. We've already had one. How is Q2 going to look? Here was 2020, the last time that we had a recession. This was obviously caused by COVID. And then, as I said, we have the CPI numbers. This is the inflation data being released May 11th. So with that said, in my view, if CPI shows less of a rise than last month, meaning CPI finally shows that it's in the decline, I think that will boost investors and company sentiment, right? Corporate sentiment and consumer sentiment. And I think that will be enough to stop the bleeding in the short term. I mean, the NASDAQ is already in a bear market. The S&P 500 miraculously has not hit a bear market yet since COVID, right? So we're down 15%, 20% would be a bear market. So, that would bring the SPY to about the 383, 384 level would be an official bear market on the S&P 500. But if these CPI numbers come out and inflation finally shows that it's taming. Remember the last time we came in at 8.5% year over year. If now inflation is less than that, and it shows that inflation is peaking, then I think that will somewhat boost investor and corporate sentiment and stop the bleeding in the stock market. Now, it doesn't mean that we're going to rocket up, because remember, earnings were not great. So if we got decreasing inflation and great earnings all across the board, then yes, I would say that we have an easy chance to get back to all-time highs. But earnings were not great, and we don't know what the inflation picture looks like. So keep your ears and eyes perked for May 11th to see what the CPI numbers will look like. Of course, we will have this on the live stream here. So obviously, subscribe to the channel and turn your notifications on to get a notification when we go live. Now, this is not all doom and gloom. As I said, there is a silver lining here. I want you to look at this. I've pulled this up before many a time, but this is basically what happens when investors, buy the fear, right? So when the volatility index, which is basically the best fear gauge that we have in the stock market, is above 30 and above 40, and if you do all your buying during those times for the long term, then your gains are exponentially better than those who buy at the tops when volatility is low. Right now, the VIX is 32. 30 is appearing to be the new normal in this crazy market situation that we have. For most of 2021, 20 was the normal, right? But now 30 is the normal, and we're routinely getting above 35. You definitely want to use this as an opportunity to start building a solid long-term portfolio and not pay attention to the day-to-day. One of the things that I recommend is for people to open 2 accounts, one for trading if you want to be a trader, and one for investing. Do not look at your investment portfolio as long as you do your due diligence and you invest in great companies, right? Blue chip value companies, blue chip growth companies, and you are not pouring in large amounts of money into PayPal or DraftKings or whatever. You can play with those for just an incremental percentage. But if most of your portfolio is in blue chip companies that have a track record of growth and earnings for decades, you don't need to look at this portfolio every day. You could just add to it when the VIX is high, or add to it when it is in a bear market, like a lot of the mega caps are, and use a separate portfolio for trading, so that you are not affecting your long-term decisions by what's going on in the short term. And if you're confused and you're not yet confident in your ability to pick individual stocks, there's nothing wrong with going with the SPY or the SPY V, which is the value ETF of the S&P 500, or the NASDAQ itself, the triple Qs, right? We are in a bear market now. Buying during bear markets has always been profitable every single time throughout the entire history of the stock market. It's just not fun to look at on a day-to-day, and you don't need to. Anyway, traders, hopefully you got something out of this video. Hopefully I broke down exactly what the Fed is initiating with their new monetary policy, what it means when the Fed reduces assets off of the balance sheet, why it is not all doom and gloom, why it behooves you to buy when the volatility index is high, why you should have 2 different accounts, one for investing, one for trading, so you're not affecting your long-term investment decisions by what happens in the short term, and why adding tools to your arsenal like day trading, like options trading, swing trading, etc., is vital if you want to survive on a day-to-day basis and you want to be able to make money off of this type of volatility. Leave a comment down below. Let me know what you think of this video. Let me know what you think of the Fed's decision. Did they go just right? Did they not go far enough? If you want access to all of our trades, if you want access to the community, the chat, the bots, the education center, etc., link is in the description below. Almost 30% off the monthly subscriptions if you use the limited coupon code that you see right there. Hit that thumbs up. Stay safe out there, traders. Peace.